Mohamed, first question to you, sir. Just how high is the hurdle to hike interest rates at the Federal Reserve? And does this conversation get started after a print like that?
So I think it will get started in certain segments of the market. It will not get started within the Fed. And you know what? You've heard me say this over and over again, John. If the inflation target is truly 2%, then we would be talking about hikes. We wouldn't just be talking about postponing cuts. Look, there's three things that are very clear from these numbers taken at face value. I'm going to come back to the face value qualification. One, they are hotter than what the Fed seems to expect given its signals, and they're getting hotter. Second, and this is where I differ with David a little bit, they are consistent with a whole host of other data points. This is not some outlier. They are consistent with what we've seen in other places. And also, they are consistent with the hypothesis that companies and other segments of the population are much more sensitive now to actual and expected cost increases. This is not a repeat of 2021, where you have an unanticipated inflation and people don't adjust quickly. This is a different economy.
So, Mohamed, are you suggesting that this economy is more inflation-prone now than it was several years ago?
More inflation-sensitive now than it was before. But where I agree with David, and this is a conversation that the Fed doesn't want to have, is that it's okay to have slightly higher inflation for now. You don't want to pull the rug from under U.S. exceptionalism. There's already a lot of uncertainty in the environment. Finally, John, the face value qualification was important because not only, as Mike pointed out, do we have the annual updates to all sorts of measuring things, but we also have the impact of the wildfire. And we simply don't know what the net effect is. But at face value, this is certainly not good news for the Fed. And the bond market and the equity market is reacting accordingly.
Mohamed, there are two aspects to this. On one hand, you can say this truly is a more inflation-prone market, and especially with companies more able and willing, like Coca-Cola, to pass along price increases, you could see a spike upward. So you should respond as a Federal Reserve to tamp down that inflationary pressure. And on the other hand, you're saying that the Fed should be patient because 3% inflation might be okay as long as it keeps going downward. Which is it? What is it appropriate to respond?
So it goes back to two issues. One that Powell is finally willing to talk about, and the second one that he doesn't want to talk about. The first one is what is the neutral rate? And he said yesterday that the neutral rate had meaningfully moved higher. The other one is what is the right inflation target? And that's the one he doesn't want to talk about. You know, my hope is that this Fed will understand that if it could, and I understand why it couldn't, if it could talk about what is the right inflation target for an economy going through massive structural change, it would not be so obsessed with 2%. It would be flexible. It would target a range. So look, Lisa, it can be both. It can be that you should tolerate slightly hotter inflation prints, assuming that expectations remain relatively stable. And then you should promise us 2% down the road, but please don't target 2% for any time soon.
Mohamed, I'm struggling with the idea that the average inflation might be 3%, but Anne Marie's eggs are 15% higher. Or, you know, you go to fly to a popular route and suddenly it's 20% higher. That there are select pockets of inflation where companies see they have the ability to kick up prices in a way that maybe they weren't at a time 5 years ago when this was a less inflation-prone market. Does that raise concerns about longer term how much this could affect consumer confidence, especially at the lower end of the consumer scale?
So I think there's two things. Eggs is, like David said, that is a supply shock. Very different from higher prices for something where the demand is very high and the supply is inelastic. So, you know, these two things are happening, but they're economically very different in terms of attributes. And that's the reality of an average inflation rate, is you have things going up very high and things going very low. The key thing to remember, at least what I look at, is the bet that the Fed and others were making is that service inflation would come down fast enough to offset goods inflation that is no longer going down, no longer going negative. Now what we're seeing is goods inflation is starting to pick up, and service inflation hasn't come down fast enough. And I think that is a nature of the economy that we're functioning in right now.
If that's the nature of where we are right now, was it an error, a policy error for the Fed to cut 100 basis points?
And Marie, I believe that this Fed has no strategic anchoring. It is a ridiculous sequence that we've had. In July, there's no need for a cut. In September, there's need for a jumbo cut of 50 basis points. And not much has changed in between. Then we come to the next two, and we are recalibrating, meaning we're getting down to the 25, regular 25. Now suddenly, there's a huge discussion. Are we skipping? Are we pausing? There is no meaningful forward policy guidance coming from this Fed. And that is the mistake. That is the big, big mistake, is that they are just incapable, it seems, certainly unwilling, but it seems incapable of taking a strategic view of where the economy is going. They have been so burnt by their huge mistake in 2021, where they did take a strategic view, but they took the wrong strategic view, that they don't want to take any strategic view. So look for the Fed policy not to act as an anchor for this economy, but to fuel volatility further. And I think that is the basic problem we have right now with this Federal Reserve.
Mohamed, though, is this the Fed's fault in terms of what's going on right now, or is it just because they're dealing with a tremendous amount of uncertainty because they don't have clarity on some big policy issues in Washington?
Well, what I just said predated the great uncertainty in Washington. It predated it. So the Fed has a problem. But you would hope that when you would look around and companies look around about in this uncertain world, that they at least think that there's one bit that provides the anchor. And the Fed is not doing that. So whatever volatility is in the system right now, the Fed will amplify it. And that's not what it should be doing. And that's not what forward policy guidance is all about. But if you are excessively data dependent, you will amplify it.
Mohamed, Adam Posen, the Peterson Institute, thinks the next move is a hike. Torsten Slok, Apollo, has made the argument on this programme a number of times, thinks potentially the next move is a hike. When you think about the next move, and you know what the next question's going to be, is the next move still a cut, or is it a hike?
If they believe in that 2% inflation target, the next move would be a hike. I think they will tolerate high inflation without telling us they're doing so. They're just going to keep on promising us that everything's going to be fine. And I think that we are going to be pausing. The pause button is going to be on a lot longer than what the market has been expecting.
Do you think that should be a feature of today's conversation of day 2 on Capitol Hill in front of the House Financial Services Committee? Is this committee tacitly accepting a higher inflation rate, an inflation rate that they shouldn't be targeting?
This committee should be having a very detailed talk about monetary policy, and it should be talking about the different scenarios that are facing the economy right now and what is the role of monetary policy. That is what it should do. But, you know, depending on your sports, Chair Powell is in the game of either sidelining difficult question or punting on difficult questions or ducking and weaving on difficult questions. He doesn't want to make news. He already made some news yesterday that I don't think he was comfortable making. So even if you get the questions, you're not going to get the answers.
Mohamed, putting together what you're saying, if this Fed does want to tolerate a higher inflation rate, is this neutral? Not necessarily any distance at all from neutral.
So you've heard me say this again, and that's because I focus on the structural element of this economy. We are very near neutral. We may be at neutral already. The economy has fundamentally changed from what it was in the last decade. And that's because the supply side has fundamentally changed. So yes, I've been saying this for a while. Okay, we are very close, if not at neutral. And I heard Chair Powell yesterday say that, for the first time he said this, that the neutral rate has moved up meaningfully since in the last few years.
So, Mohamed, just a final question then, with that in mind, and that has implications for the front end of the curve. What would this mean from your perspective for the bond market going forward from here? The shape of the curve, how things look compared to how they looked a decade ago?
So the front end and up to about 4 or 5 years is easier for me than the long end. And it's easier for me because I think the market is gonna move to the expectation that we're not gonna get a cut for quite a while. The long end, John, is really hard. You have a massive tug of war right now in the big five. Deregulation, fiscal, both on the expenditure side and the revenue side, trade, immigration, and what's the fifth? And I'm missing a fifth one. I'll think of it in a minute. So those big five, John, are not clear how they're going to net out yet. And that's going to impact the long end in a meaningful fashion.